Good morning, and thank you for joining us. My name is David Aikman. I'm the director of the Qatar Centre for Global Banking and Finance at King's College London. And it's my great pleasure to welcome you to our annual conference. Over the next 2 days, we'll be discussing the latest thinking on the role of central banks in these hugely challenging times we find ourselves in. We'll come to the programme itself shortly, but without further ado, let me pass the virtual floor to Lord Christopher Geidt, Chairman of King's College London, and to His Excellency Sheikh Abdulla bin Saoud Al-Thani, Governor of Qatar Central Bank, to introduce today's proceedings.
Thank you very much, David. Let me begin by renewing our welcome to all for this inaugural annual conference of the Qatar Centre for Global Banking and Finance at King's College London. Much to our regret, with the ongoing pandemic, we're unable, of course, to hold this event in person and to welcome you to our beautiful new Bush House campus in central London. But by now, I think we're all quite used to the virtual conference environment, and I'm quite sure it'll be no less conducive to challenging ideas and productive dialogue and debate. The purpose of this year's conference is to discuss the challenges facing central banks in the 2020s. We'll be discussing the latest research on the impact the pandemic is having on our economies and what this means for central banks' policy toolkits and frameworks. We'll also discuss other longer-term trends in the global economy, including the impact of how interest rate environment and the role of the financial system and central banks in the transition to a low carbon economy. The founding ethos of King's is simply to make the world a better place. This mission has never been more significant. The college was built on an ambition to serve society, and during the past year, we have achieved this through our world-leading contributions to fighting COVID-19. This has included Professor Tim Spector's tracking app that will be familiar to many UK-based attendees. It has also included groundbreaking research on the effects of the virus. The Qatar Centre for Global Finance and Global Banking and Finance is playing its role in supporting King's mission too. And this would not have been possible without the partnership with Qatar Central Bank, for which we are so grateful. On behalf of King's College London, I want to extend my gratitude to Qatar Central Bank and its employees for the advice, guidance, and support it has provided to the centre during this year. We look forward to a time in the not too distant future when travel is unrestricted and we can once again visit your beautiful country. So with that, it's my great pleasure to introduce His Excellency, Governor Sheikh Abdulla bin Saoud Al-Thani, to introduce our conference.
Well, thank you, Lord Geidt, Member of the House of the Lords and Chairman of the Council of the King's College London, and distinguished guests, and good morning, everybody. I would like to thank you all for the opportunity to participate in this virtual conference and welcome each and every one of you. I would also like to thank Lord Geidt for the thoughtful remarks which reflect well the strength of the relationship between Qatar and the United Kingdom, and importantly between Qatar Central Bank and King's College London. I would also like to congratulate the researcher who have put together interesting idea focusing in different aspects of central banks, which can better inform policymakers on the challenges they face going forward. 1 year into the pandemic, global growth prospective once again appear to be uncertain after showing some sign of recovery in the beginning of the year. The recent projection by the IMF indicate that growth will rebound to 6% in 2021. After taking into account the concerted effort of the vaccination and support measures. However, the recovery appeared to be uneven, presenting new challenges for policymakers in these countries. The second and subsequent waves of the pandemic in several countries are proving to a significant threat toward the holistic recovery. In this evolving situation, the growth expectation primarily depends on the continuation of support measures, as well as continuation of policy initiative focusing in the affected sectors of the economy. In Qatar, the government, as well as central bank, have undertaken proactive policy measures to support the economy and the financial sector, including a small and medium-sized enterprise. The oversize of the package was about $21 billion, or about 14% of the 2020 GDP. These measures were introduced in March 2020 during the initial days of the pandemic to address rapid deterioration in economy activity. Taking account of the evolving development, these measures has been extended ranging from 6 months to 1 year. In this dynamic environment, there are several challenges that we face as central bankers. These challenges related both to financial and non-financial firms and can be systematic or non-systematic in nature. Allow me to briefly highlight some of these challenges. The global slowdown has led to a significant interest rate distortion. This in turn has affected the saving and investment behavior of households and firms. As economies recover and policymakers plan appropriate exit strategies, it raises the question as to how better can we apply our policies tool to improve economic and financial resilience. Conventional indicators such as GDP have proved to be less useful in the crisis environment. This has raised the need for fast-moving and more reliable indicators that can better predict the behavior of the economy, especially during challenging times. What indicators could be appropriate in terms of their usefulness and relevance? Third, the COVID-19 pandemic has led to a profound shift in consumer behavior. This crisis could lead to even more widespread acceptance of digitalization in our lives, perhaps significantly affected the way we work, socialize, entertain, and learn. Under these circumstances, how can central banks help banks cope up with these challenges? COVID-19 pandemic has shown that bank supervision need to be much more technology-driven than in the past. Lowering dependency on on-site inspection and have a more technology-focused approach toward bank supervision would be required in order to improve supervisory focus and efficiency. This will not only require high-quality data, but also call for strengthening supervisory capacity across multiple areas. What are the pros and cons of such an approach? It would be important for central bank as a regulatory to be better informed in this regard. Finally, the policy response to COVID-19 is a blueprint for climate protection policy. In this context, central banks have been increasingly facilitating the transition to a green economy through policy measures. As these measures gain momentum, there is a need for a high performance, low carbon, and cheap sources of energy that permit climate-friendly growth. The role and relevance of these measures and the transition path toward these measures will become an important concern for central bank in the near future. Research can inform us on the pros and cons involved in the transition. Let me conclude by thanking you once again for your participation in this conference. I want to especially thank Professor Aikman and Professor Francisco for helping organizing the next 2 days, as well as the rest of the faculty of their participation. I'm sure that the idea and discussion over the next couple of days will provide useful practical insight that will enable central banks to improve their decision making to ensure safe, sound, and more resilient economics in these years ahead. Thank you very much for listening to me. Thank you.
Thank you very much indeed, Your Excellency and Lord Geidt. The remarks you've just given, Your Excellency, really tee up our program very, very well. So thank you very much. Now, before I introduce our keynote speaker today, let me just say a few brief words of housekeeping. Firstly, today's discussion will be devoted to the challenges ahead for monetary policy. We have 3 sessions throughout the day covering, respectively, the macroeconomic consequences of the pandemic, negative interest rates, and then monetary policy strategy more broadly. And at the end of the day, we have an excellent panel discussion lined up for you. Now, you can navigate through these sessions by clicking on the agenda tab of the conference platform. It's very intuitive, but you can raise questions through this platform if you have any. Now, there is an ask a question box within each session, which will allow you to ask questions to the presenters. Let me encourage you all to use this actively. We really want the conference to air lots of different perspectives and to promote a lively discussion of the issues that we're putting forward. Secondly, alongside the main presentations, we have a really excellent set of bite-sized presentations for you in our virtual poster session, which you can access via the posters tab on the conference platform. I particularly like to highlight the posters of the 8 shortlisted candidates of the Young Economist Prize. The winner of this competition will be announced tomorrow, so you can look forward to that. These are really, really great presentations, and I'd strongly encourage you to take a look and leave some constructive feedback for the presenters. And with that, it's really a great pleasure to introduce today's keynote speaker, Professor Lucrezia Reischlin, to kick our conference off. Lucrezia needs absolutely no introduction from me, but she's Professor of Economics at London Business School. She also chairs the European Corporate Governance Institutes. She is a CPR Research Fellow and Trustee, as well as being a trustee of the IFRS Foundation and a fellow of both the British Academy and the Econometric Society. Lucrezia, we're really thrilled to have you kick our conference off, and the floor is yours.
Thank you, David, and thank you for the invitation to this conference, which is promising to be extremely timely and interesting. So I will talk about the topic of this conference, the future monetary policies, but with a particular focus on the experience of the European Monetary Union. And my talk will be in three parts. In the first part, I will argue that the changes to the size and the composition of the balance sheet of the central banks and the policies associated with that are going to stay. So this is a new normal. In the second part, I will talk about the implications that this has for the institutional design of central banking in general, and in particular, in the European Monetary Union. And in the third part, I will draw some lessons for policy, history, and institutions. So I will be quite broad in my approach. So let me start with the first part and just illustrate some facts which are probably well known to all of you. Central banks' balance sheets have grown since a great financial crisis of 2008, reflecting a greater role of central banks, the central banks have had in financial intermediation. This has happened in steps as the effect of larger shocks, but also as a reflection of a new normal in the conduct of monetary policy. And the composition of central banks' balance sheets, so not only the size, but also the composition of the asset has changed over time, reflecting different criteria in asset purchases and lending. Here, I've just given you the example of the balance sheet. This is the Eurosystem assets in blue. You see that the first jump was in 2008 after the failure of Lehman Brothers. Then we had another jump here in relationship to the debt crisis, the European debt crisis, with the program that I will comment on later, the security market program. And then we had another jump in 2014, end of 2014. These are new policies that the ECB implemented facing a decline in inflation expectations, and then the big impressive jump here with the pandemic. The other lines, messy lines here are the various interest rates which are relevant for policy in the Eurosystem. So historically, there are analogies with previous episodes, for example, in relation to currency crisis, financial crisis, wars. And this leads to the conceptual question, what are the rationales for central banks' balance sheet policies? Have these disappeared as market conditions normalize and the economy recover, or is this large size going to have to be considered like a new normal? So let me start by saying that there are two rationales for these non-standard measures that central banks have implemented, which then are reflected in this increase in the size of their balance sheet. The first one is that central bank intermediation substitutes for private market activity when financial market size up. And here, I think a nice example is what happened at the very beginning of the financial crisis, now more than 12 years ago. So here is the interbank money market, a market where banks lend and borrow from each other overnight, okay, when, banks which have excess liquidity lend to banks which fall short of liquidity requirements overnight. And this is kind of, a big, links between banks. And at the end of these chains, of course, there are the savers and the borrowers. With the crisis, starting with the summer of 2007, but especially after the failure of Lehman Brothers in 2008, this market collapsed. Banks didn't trust each other anymore. And so with the collapse of this market, the biggest, the chain that we need to connect savers and borrowers also collapsed. So what did the ECB do? I mean, basically, it replaced the balance sheet of the European Central Bank. I mean, this has happened in other jurisdictions, replaced, the private market. These markets are connecting banks overnight. So you see that the balance sheet increase in size was the endogenous effect of, in liquidity policies that consisted in, lending to banks in need of liquidity and actually getting reserves or deposit from banks which were in excess of liquidity. So this is, sort of the central banks become an intermediary of last resort, if you want. So, this is an example which I like very much because it explains that although at that time the European Central Bank did not adopt the rhetoric of quantitative easing, which was the term and the policy that was adopted in the US and in the UK at that time, still it expanded its balance sheet, increasing reserves on the liability side against largely conventional asset repos on the asset side. So the ECB largely dealt with banks by applying, if you want, a pure version of what is known as the Bagger rule, lend freely against collateral, and consistent with the Friedman rule, provide liquidity and marginal cost of production, which is essentially zero for a central bank. So you can call this a market operation approach to the lender of last resort function. It makes sense in a market where banks are dominant, in financial intermediations. But another example of this balance sheet increasing as the endogenous consequences of liquidity policies is also the Pandemic Emergency Purchase Program, the so-called PEP, which was implemented in March 2020 in response to COVID. Here, we had a mix of asset purchases rather than loans, but in both cases, policies were aimed at relaxing liquidity constraints and therefore at supporting financial intermediation. In both cases, the effect has been a compression of interest rate spreads, okay? And this is exactly, the objective of those policies. Now, if you want to see what has happened more recently, this is, after March 2020, this is, the PEP announcement is here around March. And, you see that these are the 10-year sovereign yields of different countries. You can see a compression of the spreads between the periphery country, the so-called periphery countries of the euro area, Portugal, Spain, and Italy, with respect to Germany and France. But the same you can also see after the PEP announcement in the corporate bond market, where the yields of the riskier assets, so the spreads between the riskier assets and the riskless assets, were compressed. So this is okay. So this is the first rationale for liquidity for balance sheet policies. Okay, central bank intermediation substituting what the market doesn't do. The second rationale is the most traditional one, which is now becoming almost textbook. So once the scope for conventional monetary policy easing, so lowering the level of short-term interest rates, is exhausted because we have reached the zero lower bound or the effective lower bound, alternative measures are needed to ease financial conditions facing the private sector. And these, are the asset purchases related to the quantitative easing term. Now, what are the differences and what are the similarities between these two different motivations for balance sheet policies? So the first rationale emphasized the complementarity between standard measures and conventional monetary policy. So those are the first category I described. The second, the traditional QE, is a proactive, reactive approach to addressing micro implications of financial tensions, typically aim at affecting the long end of the yield curve or reducing returns on safe assets, pushing investors further along the risk and maturity spectrum. Examples of these policies, of course, all that you did in the UK, but also the asset purchase program, which was implemented in the ECB in 2015, and partly, some of the new programs have also had that kind of rationale. So these are the differences: complement versus substitute. Similarities, there are also similarities. Capital market frictions create transmission channels for non-standard policy actions. This is why this policy works, because there are those frictions. Without frictions, arbitrary condition would neutralize their effect. So the issue is the magnitude, the extent of these frictions. We know that, of course, during big financial crises, frictions are all over the place, but we also know that in normal times, financial markets do not work perfectly. And so this actually, shows, explains why this policy have been effective. Now, empirically, what do we know? We know that central banks' expansions since 2008 has not been unique historically. I mean, that I mentioned it before. So the closest example of the policy I've described is what happened after the Second World War. In terms of magnitude, this is probably the closest examples, but also another example is the Asian crisis, the accumulation of foreign exchange reserves for self-insurance against sudden stops. The second thing that we know empirically is that crisis can have a very persistent effect on the size of the balance sheet, okay? And so this is is something that we have to have in mind when we think about, what's going to happen in the future, in the, post-crisis, if there will ever be a post-crisis situation. The third thing that we know empirically is that the institutional context in which central banks operate is crucial in understanding the likely evolution of the central bank's balance sheet. And this is a key theme for understanding the evolution of the ECB balance sheet in the years to come. And, this is what I will actually focus in the second part of my talk. But before I get there, I just want to say something more about, the rationale of these policies and why we think they work, and therefore, they are, likely, to become the new normal. So to kind of address that problem, let's ask ourselves, what did we used to think about what was the right thing to do? Okay, what was the pre-crisis conventional wisdom? Well, the first thing that we thought is that capital market frictions were of second order, that efficient market assumption is a workable approximation, and that financial quantities in general, so the size and the structure of the central bank balance sheet in particular, irrelevant. That was like the consensus that came out from academic, but also the practice of monetary policy. So as a consequence of that consensus, there were certain things that central banks were supposed to do, and certain things that central banks were supposed not to do. So what were the do's? Satiate the private sector demand for liquidity, since production of liquidity is costless for central bank. This is called the Friedman rule. Second, the central bank's balance sheet are designed to steer and smooth the short-term market interest rate, but that's the main tool. And then you have to stand ready to provide liquidity according to the Geidt rule, so lend freely against good collateral. And what we were not supposed to do, the don'ts, finance government, either directly or indirectly, assume government or fiscal responsibility, for example, subsidizing certain sectors or regions, take on risk, especially credit risk, and interfere with market functioning. So the approach was a handoff approach to policy implementation. And these principles were shared by central banks with different strategies, dual mandate, inflation targeting, or the two pillars strategy of the ECB. So the resulting policy regime was one in which a central bank was supposed to be independent. They had to have a narrow mandate to maintain price stability. This is typically associated with inflation targeting or some versions of it. And, central banks' balance sheet had to be narrow. Now, since I'm going to focus on the euro area, I want to say that the Maastricht Treaty is being the child of that consensus. So the design, the institutional design of the European Central Bank is the child of this consensus, which is actually a consensus that was not just European, actually came, largely from academic research in the other side of the Atlantic. Now, with the financial crisis, this consensus has been challenged. We now know that capital markets are riddled with financial frictions, also in normal time. And this also, the financial crisis was a reminder that episodic financial stress can prove very disruptive. So the implications was now that the implications have been that now we are also in a new regime, if you want. So we now know that the size and the structure of the central bank's balance sheet matter for macro outcomes and policy transmission. Even in normal time, so the neutral policy rate is determined jointly with the neutral balance sheet, and especially during crisis. And this raises the issue of whether the neutral central bank's balance sheet should be prepared for crisis, for future crises. And this is related to the issue, what is the right size of the central bank's balance sheet? What is the new normal? So central bank's balance sheet in normal times, in the so-called neutral setting, will probably be bigger than pre-crisis. And other things equal, this will serve to depress the neutral policy rate. More generally, the institutional design rules that do not cover exceptional times, so that the rules in the institutional designs that prepare us for exceptional times are incomplete. We should have principles that apply during crisis and during normal times. And there are some lessons about the ECB experience that are very important in coming to this conclusion. And this is what I will turn now. So I will start with part 2. So what have we known? What have we learned in the last 12 years that could guide us in thinking about the future? So in the second part, I will address 4 themes. The first theme is managing liquidity tensions. So in that little diagram about the interbank market, I show you what the ECB did in the first part of the crisis. So, and the ECB proved adept at dealing with liquidity tensions in that phase of the crisis. The state-of-the-art operational framework for policy implementation that the ECB had gave the basis for intervening in markets in a market compatible with this, what I call this market operation approach of the lender of last resort function. And, at the time, the problems that were faced in the first part of the crisis could be described as pure liquidity problems. And because liquidity problems fell naturally into the normal domain of central banking, the institutional tensions and need to manage interactions with other policies were less of a problem. These were manifested itself much later in the years. So there is quantitative research showing that those policies were effective. This is an exercise of a paper of mine, which was published a while ago, where we have the loans to the corporate sectors. This is what we observe, is the blue. And this is a counterfactual path, so it's the path that would have prevailed if the policy had not been implemented. Now, this is not, the place, to give you the details of that exercise, but, it is pretty clear that, the observed path show you, much robust loans to corporate than what we would have observed if the policy had not been implemented. So success, liquidity policy were successful. Now, second theme, dealing with solvency problems. By contrast to these kind of success stories of the first phase, once solvency issues came to the fore, solvency in the banking sectors, link also to issues in the corporate sectors and so on, the governance weakness and the lack of fiscal backing became a debilitating constraint on the implementation of unconventional measures by the ECB. Lacking clarity on fiscal support that they would enjoy if potential losses were realized, and fearing the political complication associated with the cross-border distributional impact of such losses, the ECB was more cautious and thus tardy and tentative in implementing policies that would have helped to stabilize both the euro and financial sectors and the macroeconomy. And, here there is actually an interesting phenomenon. These are the, the special liquidity operation to banks under Trichet, and those are the special, so these are called long-term refinancing operations. So that's phase one, and that's phase two under Draghi. So Draghi actually continued the policy of Trichet, actually the standards, the maturity of those loans, and quantitatively those operations were actually more sizable. However, that policy phase was not as successful, and here is also some results from another paper of mine in which actually we do counterfactual based on balance sheet data. So you see, these are domestic loans to firms and households. The black dots is what you observe, and the yellow are, the path that you would have observed conditional on what we have seen about business cycle data. So in a kind of, this is the yellow is what would have happened in normal circumstances, if you want, and the black is what we have observed. So the anormality, the anomaly of that situation. You see that loans were quite business as usual, so they did not collapse in the first phase of the crisis, but actually they did collapse in the second phase of this crisis. What was, this is the asset side of the balance sheets of banks in the Eurosystem. Here I want to stress another diagram which gives you, the same, this is the same exercise for the holding of domestic government debt securities. What you could see is that while, loans actually flattened out, banks increased purchases of domestic government bonds. So there was a substitution from loans to government securities, while the holding of non-resident collapsed. So what we have is that banks not only substituted loans to government bonds, but also substituted domestic government bonds as opposed to foreign. The foreign kind of left the market, if you want. So there was that kind of substitution. So from 2009 to 2011, we see a substitution from loans to sovereign bonds and a home bias in sovereign holding. So on the first phenomenon, we can see that there was a sort of carry trade. Banks were borrowing from the ECB at a fixed interest rate, and they were, using that money to buy government securities. And then at the same time, there was a flight to safety and a sort of a moral suasion from governments to the banks, to buy, domestic government securities. Now, this is a quantitative exercise, but if you want to see just the data, in raw form, okay, so this is the Eurosystem financing operation I showed you before. And here you have the flow of loans, and industrial production. So you see that the loans, so here there is a, of course, loans and industrial production typically are very highly correlated, but in the second period, the correlation kind of collapses. Although there is a recovery, the kind of the downturn in industrial production is not that severe, the collapse of loans is quite severe. So this is a period of a severe credit crunch. So the ECB was proactive, but in absence of other policy addressing the solvency issues of banks through asset quality review, recapitalization, and in absence of more aggressive fiscal policy, actually, these policies were quite inadequate to deal with the new problems as they manifested themselves, so solvency rather than liquidity. So let me then now get to the theme, to the third theme, building institutions and improving governance. Here, what is relevant is the comparison between the unsuccessful attempt of the ECB in 2010 to implement an asset purchase program buying sovereign bonds, so traditional QE, to calm, the rates that were spiking up in the periphery in relationship to the Greek debt crisis. And the comparison between that policy in 2010 and the more successful, which was actually unsuccessful, as I will show you, and the most successful policy implemented later in 2012 by Draghi in the outright monetary transaction. So let me just say a few things about the first policy, 2010, the security market program. On the 14th of May in 2010, the ECB established this security market program and asked national central banks to buy government bonds of stressed countries. And this program was initially a response to the Greek debt crisis, but then extended to Spain and Italy. And, eventually, the ECB spent 220 billion euros in sovereign purchases between 2010 and 2011. Now, the OMT, the outright monetary transaction, actually happened later in 2012. And, when the worsening of the sovereign debt crisis, Mario Draghi declared in July during a conference in London, within our mandate, the ECB is ready to do whatever it takes to preserve the euro, and believe me, it will be enough. So it announced an uncapped support to sovereign under certain conditions. So here, what is relevant is that Draghi, whatever it takes, was, the announcement took place in a context with renewed political effort at, addressing some of the issues that I referred to earlier, like the issues of insolvency of the banking sector. And, those were the years in which the banking union project was put into place. And actually, so the political consensus and support for that announcement was there, while was not there at 2010. As a consequence, the first program, the 2010 program, lacked credibility as a limited and temporary program. In fact, it was announced as temporary. And it was seen as subordinating private bond holders of stressed country sovereign debt, given lack of fiscal backing. And so this was also something that actually spooked the market. If you look at the 10 years government bond dynamics, this is the S&P program, the first one. You see these are the bonds the bonds yields for Italy and Spain. You can see that notwithstanding the 200 billions of purchases, actually the interest rate go up, while after the OMT, just the announcement, no purchases, the bonds actually yields went down. So, this is the same lesson that is actually the lesson of the importance of the fiscal support. Actually, it also applies for the subsequent period of 2012, 2014. After July 2012, there was a deterioration of the inflation outlook, inflation collapsed, but the ECB hesitated to actually implement actual purchases. The political consensus was not there. The Governing Council was divided. And so although they introduced some innovations in the policy framework, the market expect the ECB to implement QE, but actually QE didn't come until much, much later. And actually here in this chart, you can see this is the surprises in relationship, market surprises in relation to monetary policy announcement by the ECB. You could see that, of course, here there was a lot of confusion during the high period of the crisis, but there was still quite a lot of volatility after 2012, and the volatility subsides only once QE is actually implemented. This is, this is the end of 2014, and you see then, that the volatility subsides, once, the policy normalized, if you want, and, we start having a little bit of volatility just here because this is the beginning of the pandemic. So, so that just means that the period of hesitation to 2012, 2014 was very costly in terms of market confusion, but also in terms of inflation expectation, which is typically, related to that confusion. And here is the moment in which, the inflation expectation in the euro area decouple from the US. Here you have the euro area inflation linked swap 5 years. So this is the blue is the euro area and the red is the US. You see that, the decline is in both jurisdictions, but the decline is much more pronounced in the euro area. And, historically, those were associated in the two jurisdictions, while here they start decoupling and, they keep on being decoupled for, in a persistent way. And actually, my research also shows that this kind of change in long-term inflation expectations have to do with the trend and not with the cyclical, part. So these are my calculations, so that since that period, you see that a decline in trend inflation expectations. Okay, now let me just get quickly to the fourth theme, but I see that I have, about 12 minutes left, so I'll try to do my best. The fourth theme is actually the monetary fiscal interaction. What in this kind of underperformance in the second period of European monetary policies, what was the function of the package? Okay, I refer to, the importance of having also tools to do with solvency for banks. Okay, so that was the difference between the first period of the crisis and second period of the crisis. Now we are later in the 2012 and to 2016 and so on. So in that period, what is relevant is actually the interaction between monetary and fiscal policy. That was a period of very high very large and heavy fiscal consolidation in the euro area. So as I mentioned, in the end, the ECB commenced sovereign purchases, implemented QE at the end of 2014. That is the second type in my taxonomy. So that was largely as a substitute of short-term interest rate, justified by the decline in inflation expectation that I show you. So that was effective in stabilizing market concerns. I show you how that stabilized the news, the volatility of market reaction to announcement. And it was also important in compressing sovereign spreads. But the effect of that QE was quite muted in terms of, this effect on output and inflation. And here, actually, I mean, something is going wrong here that, the colors of my slides have not come out fine, but it doesn't matter. So here are impulse response function of QE shocks, which I've calculated with, in a paper with co-authors. I just want to briefly tell you that there is quite evidence, quite a, kind of clear evidence that QE had a large effect in depressing the 10 years rate, so which, the long-term interest rate, which is one of the, objective of QE, but actually did not have much of an effect on inflation and a smaller effect. I mean, it had some effect on industrial production, but here the uncertainty bands did not come out. So we can see, if they had come out, you could have seen that this effect on industrial production is actually not statistically significant. So a conjecture is that, the effectiveness of QE is actually also depends on the joint effect of monetary and fiscal policy. So this kind of active QE type of policy, traditional QE type of policy, have a large fiscal imprint since they affect the long-term interest rate, which is very important, in a fiscal sense, given the average maturity of the debt, which is typically, at least in the euro area, around 6 and 8 years on average. So this, QE has a large effect on the returns on government debt. And one way to understand the fiscal and monetary interaction is actually, and how this, this effect on returns, which is an effect on monetary policy, also has a fiscal imprint, is just to think very simply about the general government intertemporal budget constraints, which is just an identity that links the market value of the debt to future discounted primary surpluses. So since the identity involves bond returns, inflation, and fiscal variables, it can be used to learn about fiscal monetary dynamic adjustments in response to monetary policy. And here, I just want to cite my recent research and the paper that I just presented at the BIS, in which we use this identity combined with an empirical model for the business cycle horizon to show that one of the reasons why QE was ineffective in the macro sense, it was effective in the spread sense, but not in the macro sense, is because conditional on that kind of monetary policy move, the fiscal response leaned against monetary policy, so that all the adjustment was actually on the returns, and so inflation actually almost didn't move. So we actually established a difference between the effect conditional on these QE shocks and the effect of conditional on more traditional policy. So this is just to say that the monetary fiscal interaction is very important. This is a very active area of research, and I'm sure there will be lots of paper in these areas because it's clearly important. So let me just get to the last 5 lessons, and I'm going to show you some picture now. The first is Bagot and decision rules, and is the first lesson. The Bagot rule is apparently clear, logical, and consistent with the ECB's narrow mandate. But in practice, these rules are useless because the distinction between liquidity and solvency is impossible in real time. So central banks will always act to defend the monetary system, whether it's in their mandate or not. And defending the monetary system will have both monetary and fiscal consequences. So the mandate and governance structure should recognize and anticipate that. As Charles Goodhart has argued, the question is not whether or not to have a lender of last resort, but how best to organize this function so that it preserves the central bank's independence on one hand, but ensures its fiscal backing on the other. And you recognize my examples for this discussion. The second lesson is, well, here is Hamlet, QE or not QE. We have seen what was the cost of hesitation. So we have seen that since 2012 up to the end of 2014, inflation starts declining in a persistent way, while policy announcement created volatility in the market. So hesitation in the euro area case is linked to concerns about risk distribution effect of asset purchases. Ultimately, these are concerns of governments, not monetary authority. Third lesson, Samson, the origin of central bank power. The power of the central banks ultimately comes from the backing of the sovereign. And the conventional view was that the central bank's power derives from its accumulated credibility in maintaining the value of the currency, i.e., from its effectiveness in delivering price stability. But the experience of the ECB demonstrates that the power of the central bank comes ultimately from the backing of the sovereign. When the market perceives a lack of consensus and questions the willingness of euro area governments to back the central bank, the ECB's intervention as lender of last resort, notwithstanding his immense power as a monopolist of money creation, loses credibility and his actions ultimately becomes ineffective. Here, the clearer example is the comparison between Draghi 2012 with the OMT and the security market program of 2010. But also another example is the lack of policy backing of which was the consequence of the hesitation in 2012-2014. This has been different during COVID. Monetary policy action was supported by fiscal authority with the recovery plan. So I think we're making progress here. Now, the fourth lesson is the power of institutions and their design. Institutions matter. The institutional framework matters because it influences the size composition of the central bank's balance sheet. It affects the credibility of policies. It allows or not coordination with other policy, fiscal, banks, etc. Also, these two institutional design rules that do not cover exceptional times are incomplete. We should have principles that apply during crisis and normal times. And then my last, Marx, historical determinism and the formation of the European Central Bank. Institutions adapt to the need of the time. And this is why I put Karl Marx's face on the screen. The euro came into existence via the Maastricht Treaty in 1992. And its creation can be seen as the product of the forces driving the European project. Its timing was a consequence of the political dynamics among the member states, particularly Germany and France, and in turn, a consequence of external events, including in particular the reunification of Germany. But the timing of its creation turned out to be hugely important. Just at the time that the currency and the ECB was designed, the intellectual consensus had coalesced on the view that central banks should be independent with narrow mandates. Without this historical coincidence, the creation of the euro would have been seen to require much greater political and then fiscal integration among the member states. Probably we have never seen the euro if everybody had not been, in agreement that the good principle of central banks was a narrow mandate and so on. So the crisis of 2008, 2009, and the experience of the ECB in fighting its consequences ever since, and now COVID, has changed the intellectual consensus on the governance of central banks and revealed the challenge we face in redesigning the governance framework. So I will finish here. These are my 5 lessons. The last one is related to the euro system, but I think has also a more general message for about other jurisdictions, about the importance of the consensus and the adaptation of institutions to the need of the time. Thank you very much.
Lucrezia, Thank you very much. I'm just hoping my face appears on the screen. That was an absolute tour de force of ECB history over the last 10 years. I learned an awful lot, so thank you very much. We do have some questions that our audience members have posed, so I wonder if we could just take 5 minutes to kind of present to you with those questions. The first one is by Mohammed Al-Nasir, who asks, he's kind of pointing out that collateral, you have the questions on the screen. So the collateral criteria shift over time, particularly central banks kind of loosen them a lot in crises and downturns. What do you make of that approach? Is it cutting corners? Should there be a kind of a fixed rule-based system for establishing the determinants of collateral requirements, haircuts?
Yeah, I mean, that's a very good question. Collateral policy is very important. Actually talking about the ECB, I mean, I remember at the beginning of the crisis when the Bank of England criticized the ECB because the collateral criteria were too generous. And then, of course, the Bank of England had also to adapt, and every central bank had to adapt. I mean, because you don't want pro-cyclicality, right? So that, but also collateral is important in my narrative because actually was very pro-cyclical and very, the collateral policy with respect to Greek bonds during the Greek crisis has very much been criticized because it was too strict. So for the opposite reasons. So clearly, one has to have, some criteria and, a more transparent policy about collateral. And this is something that has to be fixed in, in the ECB strategy review, which is ongoing. So that is an important, issue.
All right. So another question. This is from Koskan. I'm going to pronounce your name incorrectly, Tarkasin. He's asking about, I guess, the kind of lessons for emerging market central banks here. And he's talking about whether there needs to be some synchronized actions where, reading between the lines, emerging market central banks operate in conjunction with advanced economy central banks, what the spillovers are more broadly for emerging markets. How do you view the lessons of what you said for emerging market central banks?
Well, I mean, clearly, with global capital markets that's a very important issue. That especially that emerging markets are, there are important spillovers from, especially what the U.S. does, to emerging markets in terms of exchange rate and in terms of and therefore valuations in balance sheets in emerging markets. And these are important issues. So governors in emerging market countries, for example, Raghu Rajan has asked for more coordination. I think it would be great if there were more coordination. I don't think this is going to happen, though. I mean, this is this is a problem that is there to stay. Ideally, with a lot of these problems, we need more coordination, but this is hard to achieve. So we have to, as academics, we have to keep on saying that this is needed, but whether this is going to happen or not is a different question.
Yes, that's fair enough. I think you've already answered the last question on the Q&A in your slides as you were going through it. So I might ask one myself, which is, I think in the earlier parts of your talk, you kind of introduced this notion of a neutral balance sheet for the central bank, which intrigued me when you put it like that. We're used to thinking about the idea of a neutral interest rates, and we've got an analytical framework that we can use to think about the determinants of that neutral interest rate, even if it's incredibly hard to measure in real time. Do you have any kind of thoughts in terms of the kind of general way of thinking about what should be the factors that should feed into a determination of this kind of normal times neutral balance sheet for the central bank?
But I mean, the neutral is the same thing, right? Because you could see, it's quantity and interest rates are determined, together. So that, I mean, in fact, I think that one thing I didn't say, which I think is important, is that if you think of, this kind of new policies, which is size of the balance sheet, composition of the balance sheet, all these different instruments, forward guidance, this and that, are awfully difficult to communicate. But there is one way in which would be easier to communicate them, which is in terms of interest rate. Because all of them, they have a function in determining financial conditions and long-term interest rate. So not only, short-term interest rate, but the entire yield curve. So, QE, affects the risk premium, the term premium, so the long-term interest rate, but, the forward guidance is one part also of the long-term interest rate, because it's about the future expectation of the short-term interest rate. So you could combine this policy that very often are communicated in terms of quantity to actually, communicate them in terms of saying, well, we have some kind of objective about the position, the slope of the yield curve. Now, there is an active debate of whether we should actually target the yield curve or not. Maybe this is going too far. Especially challenging in a monetary union where we don't have one yield curve, but we have several. Now, if you look at what the ECB is doing now, is communicating that in terms of financial conditions, not clear exactly what that means, but something like that, okay? So it's talking about prices rather than quantity, which is easier, I think, to communicate.
Yeah, that makes a lot of sense. Okay. I think let me kind of finish just by, applauding you for a fantastic talk, kicking us off this morning. We're going to take a short break now, and we're going to start again, with our first session of the day at 11 o'clock. So time for you all to go and get a cup of tea or a cup of coffee.
Thank you. Thank you very much.